Hello, this is exercise 20B from the active learning worksheets, straight line amortization of bond premium. Hey, there's a whole lot of stuff about bonds in here, so I'm going to try to talk through all of it while I go through it. Okay, the company issued $300,000 of 10-year 6% bonds on January 1, year 1. At 101.5. Okay, bond prices are listed as a percentage of 100. Okay, so if the bonds had been issued at 100, that means they would have been issued at the face value, or 300,000. In order to figure out how much they got for the bonds, you need to take the 300,000 times 1.015. Okay, so 101.5% of the total. Okay, this bond is interest is payable in cash annually on December 31. Okay, that is unusual. Most bonds pay interest every 6 months or semi-annually, but for this example, paid once a year at the end of the year. Then it says straight line method is used for amortization. If the bonds are not sold at face value, then we have to amortize the discount, or in this case, the premium, over the life of the bond. And that amortization is going to affect our interest expense. Okay, so first question says, use the financial statement model below to show what happens to the financial statements when these transactions occur. Okay, so they issued bonds. I'm going to scroll this up a little bit. Okay, issued bonds. That means assets go up. Okay, equity does not affect that. Liabilities go up. Okay, we got cash and we have a note payable. Okay, it's not going to affect anything else. The statement of cash flows, we're going to have, and this is just the issuance of the bonds, okay, part 1. Cash flows is going to be a positive from financing activities. Selling bonds, selling stock is a financing activity. All right, part B. Okay, determine the carrying value, the face value less the discount or plus the premium of the bond liability as of December 1, year 1. Okay, so this calculation is down below. Okay, the bond premium, okay, remember these were sold at 101.5. So 1.5% of the face value, or $4,500, is the amount of the bond premium. Okay, so that means that we sold them for $304,500. Okay, carrying value at the end of the first year. Okay, now these bonds, we sold them at $4,500 premium. Okay, they are 10-year bonds. So we're going to amortize that over the 10 years. This case, we're doing 1 year's worth, $450. So the premium on the bond was $4,500. minus 1 year's amortization means that the remaining premium is $4,050 and the carrying value is $304,050, or the total amount that was received, $304,500, minus the 1 year of amortization. Part C, interest expense, year 1. Okay, the stated amount of interest, 6%, that's the amount of interest that is paid to the bondholder. Okay, no matter whether it was sold at face value, premium, discount, whatever, that stated interest rate is what the bondholder gets. Okay, so $300,000 times 6%, the bondholders are going to get $18,000 in interest every year for 10 years. Now, the amount of interest expense that the company is going to show is going to be less than that because of the amortization of the premium. The company got more than face value for the bonds when they were sold. When we amortize that, that reduces the amount of interest expense. The company's paying $18,000, but we got extra money up front when we sold these bonds. So the amortization of the premium reduces the amount of interest expense. So the interest expense and the interest that is paid are not the same. Okay? Now, carrying value, Part D, at the end of year 2. Okay, the bond payable without the premium is still $300,000. Okay, the bond premium amount after year 1 was $4,050. We're going to take another year's amortization of $450 off of that. So the remaining premium is $3,600. Total carrying value, $303,600. Interest expense, year 2. This is going to be the same every year when we use straight line amortization. Okay? The amount of interest paid is $18,000. The amount of interest expense is the difference between the interest paid and the amortization of the premium.